All right. Happy Friday, Kyle. How you doing, brother? Oh, hang on. Let me turn your audio on. Sorry.
I should be good now.
Oh, you muted yourself. You scared me.
I did. Had
All right.
dogs.
Yeah.
But yeah, I'm doing good. We made it. It's Friday.
It's Friday. What a week. What a week. Welcome, Todd Gordon, Kyle Wasson, Inside Edge Capital. We are going to bring you up to date from where we sit here on this nasty day. It's Friday, but we've got a good little presentation. This is, really geared towards clients of Inside Edge Capital, but we're going to put it out on public site because we're not going to go into specific portfolio stuff that we obviously reserve for clients of Inside Edge. We'll be reaching out next week. It is nasty out there, but wanted to give you the high level and just kind of show you from where we sit the forces and the market dynamics at work that causes big sell-off. So we're going to try to move quickly through this. Kyle and I have been working on this pretty much on it like all week, and we made some changes at the end because of the crazy volatility. So Kyle, thanks for hanging with us, and
Yeah, we had to update it every day as things changed in the market and the world. So just one of those weeks.
that's exactly it. All right, let's roll. So this is April 19th. It was an absolute meltdown here in the growth area, not value. We'll talk about that, but this is Inside Edge, Investors Edge. That's not an accurate title. That's one mistake right there. That's okay. So we are a active management, wealth management, financial planning, registered investment advisory. We are registered here in New York. And we are, how would you describe us to those of you who are brand new, Kyle? How would you describe what we do?
Yeah, we're a wealth management firm that does financial planning, portfolio management, all the advisory and account services. And I would say what makes us different and maybe special is we really emphasize the active management and having a plan in place before we go in and start actively managing the account. So
that's a key part.
Just make sure we have a full understanding of your situation, your risk appetite, and then we go in and we don't put things in and forget about them. We're watching them with what you need in mind.
Exactly. Well said. All right. So again, this is going to be a little quick. This is going to be a little bit more rushed than we liked. It's later on Friday. It's a busy day. Our families are pulling at us, but we really wanted to get a couple of these key points out to you guys. So 3 things we're looking at: the geopolitics, the global macro update, and if you don't know what that means, we'll dive into that, and then finally the stock market update. So of course we're going to hit Iran, Israel. A lot to do with inflation and the Fed, and then as those 2 big factors, how they're impacting the stock market. Okay, so obviously, right off the bat, the most important thing right now is unrest in the Middle East between Iran and Israel. Kyle, why don't you take it from here?
Yeah, so it's been tit for tat all week between Iran and Israel. We posted this screenshot here last night. This was after Iran launched 300 drones or missiles at Israel, and then they went to the UN and said if Israel hits us back, we're going to respond immediately and at a maximum level. And then last night, after this message or this speech at the UN, Israel struck back at Iran with like a very small, they said 7 drones strike. So it's back and forth right now, but we would say the last punch that has been thrown wasn't more escalatory than the last one. And for everyone that wants a conflict. There's a lot of forces, and we think the U.S. is probably among them. People that don't want this to be a full breakout in war, but as we see it, as it relates to markets around the world and everything that affects shipping and transportation through the Middle East, plus the kind of the risk premium. Yeah, so we're going to talk about oil, how stock markets might react, and then gold and other commodities that have seen some movement just recently in the past few months.
Yeah. Yeah. And just the fact that we're now 7 months away from the election, actually less than 7 months, holy cow, it just adds, another layer of complexity on that. And we can get down multiple different avenues on that, but we're going to leave that one for now and see how this continues to develop, if it develops.
Yeah.
So let's get into crude a little bit and kind of take you through the history of the evolution of this latest Middle East skirmish. So October 7th, Hamas attacks, surprise attack on Israel from the from the Gaza Strip, and that was the initial push up here in crude oil as we're trading about $85. Biden arrives in Israel, and then through November, and then into the new year in 2024, crude makes a bottom, and then we begin to rally. Okay, so from here, Israel strikes on the Iranian consulate in Damascus, killing a couple key commanders. Iran didn't like that none too much at all, and they vowed to come back. And it took about 12 days. They launched the air attack on Israel, which the spike there in crude oil is that. And then last night's response from Israel attacking Iran, as Kyle described, there was a big move overnight in crude oil, spike up in gold, spike down in stock index futures. I was up at like 11 o'clock, and I was like, oh my God, stock index futures, NASDAQ was down 2%, gold was bid. But, those of you who don't follow the technicals that much, that long sort of tail or wick they call it, that's crude oil going up to 86, but then it went all the way back down as the market came to the open here this morning. So a lot of it was reversed. So we'll see if it continues to escalate. But the way I see it from a technical point of view, and before I say this, like the implications in crude oil are huge, both from a geopolitical escalated risk front in the Middle East, as well as the inflation fighting task that the Fed has, which as a result is moving interest rates. And if you looked at the top 3 points that we're going to cover, it's inflation driving interest rates, and interest rates are driving the stock market. That's the way it is right now. Kyle, we're doing a report on the stock market. We're not even talking about earnings, and we're now in Q1 earnings season. It's so macro driven. Like that's what's going on here. We're not even talking about earnings. Earnings probably going to be pretty good, but I think they're being overshadowed by these geopolitics, but we'll see.
Yeah, you've seen some companies beat, but then the price goes down just because of the macro picture is more important to people right now.
100%. We had Netflix report very good earnings. They took one key metric away, which is a holding of ours. And then I'm drawing a blank. My mind is fried. There was another key report this morning. I'm embarrassed to say. I'll come up with it. That was also very good. That's pretty bad. Anyway, it's just been that kind of week, but it's good. And then, looking at, as I was starting to go off in the technicals a little bit, I just included the long-term crude oil chart just to show you where we've been. The way I see this is with, escalated tensions in the Middle East, crude, I would think when I woke up this morning, we'd see $90 oil crude. $90 oil, Kyle. Say that a couple times. But crude's been dropping, and we're moving into some technical support levels. You'll watch the 50-day moving average, which is just the average closing price over the last 50 days, the 200-day. Then you get a little parallel uptrend channel. Technicians will look at that right around the $80 level. Tell you what, if we break through those, there's going to be more selling pressure coming in. And what is the implication of lower crude? That further compounds this interesting macro situation that we're looking at. Now, I'm going to hand it off to you here right now. And before we jump into this slide, I think the reaction, those, on, the headline makers, the news media, which I have a lot of friends at CNBC, been working with them for years, and social media influencers, the initial reaction on a Israeli-Iranian conflict is, wow, crude's going to go crazy. But let's look at the data, how much crude oil is represented in terms of production out of Iran. Kyle, take it away.
Yeah, so this next slide just goes into that, and it's about 4% of the world is what Iran produces. About 20% goes through the Strait of Hormuz, but if you look at production and you just kind of understand that most of the world oil supply isn't going through there, so it shouldn't be affected as much as, Russia is 3 times as much, and their oil's been under sanction for 2 years now.
Yep.
So you got to talk about Iran and any further disruption. It's another 4%. It's not. It shouldn't move the needle too much. And then,
no.
Like we said, it's been tit for tat. It hasn't been just straight escalation. With the strikes last night being really limited by Israel, I think there's until we see it break out into a war, and we understand, people have to go back and adjust for that. It's probably not gonna happen before, but it could be a sharp and sudden thing, I think.
Yeah, but I think the point that we're making here is Iran only represents 4% of the oil, and they're on the daily global production. There's already sanctions on Iranian oil, but the deal is China is sort of backdooring those sanctions and pulling in that Iranian oil. So what's the real number? We don't know. But, hopefully, if that 4% were to be challenged, maybe we could step up. I don't think Saudi is ever going to back Iran. We know where Russia stands on that. And, I don't know the ability for Canada to increase their supply as well. But I think that 4% can be made up. And I think that's a big reason that we've not seen a significant move higher in crude oil, which, again, further complicates the Fed's mission to control inflation through interest rate policy, which we're going to talk about. Inflation, we had a very strong move up in 21-22. We have since come down. This chart, you know what? I would have double checked this one. This one is not completely accurate because this is the median consumer price. Okay, yeah. So we spiked up to 8%, and now the core is down around 3.5, 3.6. So we're sub 4. I'm going to move past that one quickly. Inflation has come off as quickly as it came on, I would say, but we have stabilized, okay? And in reaction, the interest rates, okay? So we're gonna be looking at the 10-year yields, which move around in response to inflation levels. Now, inflation first appeared following COVID and the government's response to it, flooding the economy, that's fiscal response. And then we also had a lot of supply shocks as, all the suppliers overseas weren't able to ship and a lot of manufacturers were shut down. So supply side of the demand supply equation was shut down. Inflation spiked, prices went up because, again, people just couldn't get the goods. It wasn't a runaway demand side, it was just nothing available. So interest rates drove up, inflation went up as the Fed was responding. Blow off top here in 23, sell off into 24. Now, as we're coming into the first 4 months of this year, we're going through a very interesting realization. As inflation is coming off, the expectation was the market's expectation was the Fed's going to cut rates. Well, we were of the opinion that they're not going to be able to cut rates anywhere near as much as they thought. And the markets are now realizing that. So that's why the 10-year yield, this is the yield on the 10-year Treasury note, is moving up. So we're going to have more discussions on that. Now, the 10-year yield, that exact same chart, look at it overlaid with the S&P 500. There's generally an inverse correlation between stocks and these yields, right? So as yields came off at the end of 2023, what happened to the stock market? We bottomed. And Kyle, we will always look back on this period very favorably because, lucky you say, we were well positioned in that. And we're still enjoying, that move up. However, it's big time being challenged right now on the pullback. So will these 10-year yields move up further to the old highs, pressuring the stock market? That's the big question. Now, as I mentioned, earlier this year and at the end of 23, they were talking about 6 interest rate cuts this year. Then it went down to 4 interest rate cuts, then 3. Now we're at 1 to 2. And what this chart means is currently the Fed funds policy rates at 5.25 to 5.5. And it gives you the probabilities over each Fed meeting as to what the Fed is likely to do. The blue shaded area is the best odds. So the next meeting is May 1, 2 weeks from now, 99.6% chance that the Fed leaves rates as is. June meeting, 80% chance they do nothing. July meeting, 55% chance. Okay, you got 55 plus 38 plus 6, so you've got 55, 45 of a cut. 45 cut, 55 no cut. Then the first chance of a rate cut is here in September because we go from 5.25 down to 5 to 5.25. So we have a 45% chance. So what's happening now is the market is only pricing in 1 interest rate cut this year, from 5.25 to 5.5 down to this range. And again, there was 6 this year. I said there's no way they're going to cut. And Kyle, I'm kind of rolling here, so just interrupt at whenever you want, please.
Yeah, no, that's exactly right. This slide here just showing the mechanism, the red being the Fed funds rate, the blue being the yields, current yields on 2 years bonds, which that's going to go in line with inflation, and just showing the 2-year bond, it's currently below the Fed funds rate. If you look at instances where the Fed has jacked up the Fed's fund rate, you can look at '05, look at late, maybe 2018, 19 in there. And then again here, once they get that Fed's fund rate above where 2-year yields are, the yields usually go back down the other way, making it harder for yields to stay high and then harder for inflation to stay high.
Nice.
So, look at how things are now on the Fed and like with the fiscal side, how they're Congress is spending. We don't see inflation picking up any more than it already has, assuming that the federal government doesn't do any massive spending bills or stimulus that we haven't already seen.
Who knows what's going to happen?
But who knows?
Who knows? I mean, the big pivot, and this is a long discussion. Again, we're trying to be concise in this one. Kyle and I love to go back and forth and make them long and fun. But the pivot is we're not cutting rates. Does the Fed come out and say, based on what's happening, there's a big spending bill coming, based on the inflationary pressures that are out of that, the potential for crude to break up through 90, maybe the pivot from the Fed is saying we're not going to cut rates. If they ever start, back to that last one, if we ever start seeing markets price in 5.5, 5.75, 5.75 to 6, that's when I will be concerned. I think the market's going through realization that we're not going to cut rates. But, especially what kind of stimulus, as you were saying, are they capable of in a election year? And I'm collectively saying Democrats and Republicans, whatever. It's not a political statement. And we are coming into a very interesting seasonal period of the market that we'll talk about right now. So where are the short-term rates headed? That's really, really important. A different way to look at these 2-year yields that Kyle was just discussing, I'm looking at 2-year yields in red, and this is coming from the St. Louis Fed's inflation expectation. Where do they see inflation 2 years out? Now, clearly you can see the correlation between 2-year yields and inflation expectations is right on, right? The higher the inflation expectation, the more those yields, those 2-year yields are going to go up. And as Kyle just said, if those 2-year yields go up, that's going to encourage the Fed to raise rates. And as I just said, if we raise rates, if the markets start pricing in a higher Fed funds rate, that's going to be a huge historic pivot. And I am concerned about the stock market at that point. But right now, as I said, the pivot that's being sort of manifested in the market is from 6 cuts to no cuts. And if the market can swallow that and not choke, then I think we're okay. So this is 1990 to 2024, 2-year yields over 2-year expected inflation. This is from 2002 to 2024. Right now, same chart. What you'll see is in blue is the expected inflation rate. Going out 2 years, our central bank is looking at 2.5% expected inflation. That's not gospel. That's not written in stone. It's their estimate. But the 2-year yield is making new highs where the inflation expectation is making new lows. Are the 2-year Treasury yields, the bond markets, are they telling us something that the central bank, the Fed, doesn't know, or are they just a little fearful right now because of this pivot to no cuts, and the yields will start dropping down and follow where expected inflation would go? That would be the best case for the stock market. Data this week was interesting. We came out of the gate Monday with really strong retail sales. Kyle, people are spending, and they don't care what the prices are. Like retail sales right here came in 0.7 expected, 0.7 actual expectations of 0.4, the prior revision up. So they almost doubled expectations month over month retail sales. And then the core retail sales was 0.5 expectations, 1.1. So people are spending. That's inflationary. Again, the Fed's trying to find reasons to say inflation is really calming so they can maybe recommit to cutting policy rate. So the market's kind of freaked out on that Monday. And then Tuesday we came out and we had some bad housing numbers. Housing, we know, has been very inflationary. That's one of the key components of the headline and core number that's been driving inflation is housing prices and insurance on housing. Well, we had some bad housing numbers. Okay, and that's with the 30-year mortgage coming off. It was up at 7.5%. Now we're down to 6.25%, I think. But we had some bad housing numbers. And then that was followed up yesterday, by existing home sales that were also under expectation. So you had strong retail sales out of the gate that shocked the markets, and then housing kind of calmed it down. Looking ahead to next week, we have new home sales on Tuesday, my sister's birthday. On Tuesday, durable goods Wednesday, crude oil inventories, we'll be watching that. Now, this is a big one, Kyle. GDP Thursday. This is the first reading of Q1 GDP. Do you remember, I'm going to put you on the spot. We didn't talk about this in the pre-show prep. Do you remember the preliminary reading for Q4, the last GDP report? And if you remember it, interrupt me. If you don't, just listen. The expectations was 1.98 for GDP growth. It came in at 3.3, like hugely above expectations. And it didn't change because the way they announce GDP is they have the first preliminary, second preliminary, and then their final reading. Like 1.98 expectations, it came out at like 3. I'm off of my tenths, but it came out at like 3.3 and it stayed there. Huge growth in the economy. So this number Thursday is going to be huge because of recent memory of what happened in Q4 GDP. More home sales. Yep. Go ahead. Anything to add in there?
Yeah, no, go ahead.
Okay. Again, interrupt me, man. I'm supposed to be at baseball practice, but this is more important. I just texted the coaches, like, I'm on a live stream. I sent them a link to it. I was like, here's I am. You'll know when I'm done. So get the kids warming up. Oh, sorry. I'm supposed to be sharing screen on that. Sorry. So I was supposed to be sharing a screen. Let me show you those numbers. Retail sales, strong. Housing starts weak on Tuesday. Existing home sales weak on Thursday this week. And here's where we are now for next week. New home sales. GDP right here. So expectations are for a 3.4% reading. So that's pretty spicy. Again, that was after that 3 point something percent last quarter. And then Friday, we roll into PCE, personal consumption expenditure. These are the Fed's preferred inflation gauge. So the end of next week is going to be very interesting with data. And of course, we're fully in earnings season now. Retail sales, again, just a little headline. You pulled this out. Goldman Sachs doing what to this, Kyle? They up growth estimate.
Yeah. So, I mean, pointing back to the strong consumer, pointing back to, a consumer-driven economy like the U.S., the consumer drives a lot of the growth, and everything we've seen, basically except housing, which you could make an argument about renting versus buying and rates and other things that may cause the starts to be lower right now. But unemployment's still low. Retail sales are very high, higher than everyone expected. So good sign for GDP.
Nice. Okay. Good. All right. So again, kind of looking at CPI and the 10-year yield. This is a little bit of a history lesson, but we're going out to the 10-year yield. The 10-year yield is not really representative of what the Fed's doing. The Fed, and when they meet, every 6 times a year and they set the policy rate, that's the short-term rate. Kyle and I both had slides that show you that correlates to the 2-year. The 10-year is a little bit more open market determined. There is government, buying and selling in there, but it's more determined on the free market. The 10-year yield also determines the 30-year fixed mortgage, auto loans, credit card rates. Like, that's the key yield in the U.S. economy. There was kind of this switch as we headed into 2019. The Fed had raised rates a couple times, 15, 16. We got some interesting volatility in here, but it seemed to be that CPI, which is the Consumer Price Index, which we just talked about, the year-over-year change was almost trading inverse to bonds, to the yields. And now after 19, we're seeing a pretty good correlation here. So this is a better look, Kyle. I think that one CPI was off, that price index. This is a little bit more accurate. We're about 3.8 on the year-over-year CPI. And you can see in green, we came off almost as fast as we went up as supply chains have opened up. Yields are coming back here. And, we'll get to see what happens on those 10-year yields. Quickly on this, I've showed this one before. So this is the so-called yield curve. And if you listen to the media or anyone, they're talking about yield curve inversion. And what we're doing here is pulling together the conversation on 2-year yields versus 10-year yields. In a normally functioning economy, the 10-year, the longer duration treasury yield is higher than the short term. That is in situations like this. You want to see longer rates higher than shorter rates. When shorter term rates like the 2-year, which again is driving where the Fed sets the rates, when that's higher than the 10-year, the longer term rate, that's called yield curve inversion. And that generally signals an economic slowdown. It's not the case this time, and I have a lot of reasons why. We've covered it in prior broadcasts, but I'm going to leave that one for now. So the good news is the yield curve is coming out of inversion. Right now we have 0.3% difference between the 2-year and the 10-year. The 2-year is 0.3% higher than the 10-year. Okay, the 10-year, 2 years about 4.85 right now, and the 10-year is about 4.5, 4.6. Now, I think. And this is a different economy because we have inflation for the first time in a long time. You can't look at a 5% borrowing cost without looking at the inflation that's currently happening in the economy. That's the so-called real interest rate. If you have nominal rates at 6%, but you're running inflation at 3%, for you to borrow money and service that debt, your $300 that you're paying towards that debt every month with 3% inflation is becoming 3% cheaper. So your net borrowing cost is 3%. So you need to look at inflation adjusted yields on 10s, inflation adjusted yields on 2. Take the difference between that, and then all of a sudden you get a yield curve that is coming out of inversion and is almost positive. This is a key difference that we have not seen in years past. And again, much different discussion about the 70s. And people say, wow, roaring inflation, we're going back to the 70s. We're a long way away from where we were in the 70s and 80s because of where real interest rates are, where the Fed funds is compared to core CPI. The real borrowing cost is very low compared to what it was back in the 70s. Much longer discussion. But this is constructive right here, the real yield curve coming out of inversion. Tips, sir.
Yeah, so tips, looking at, if inflation is persistent, are tips a good investment right now? We think they're good for more over the short-term horizon, and, for the instance where things don't go as expected and inflation does return, maybe we see another rate increase. That would be the scenario where tips would outperform. The other kind of bond consideration we have right now is with yields going up, it's pushing the price of longer term US bonds down. Like the TLT, it's the 20-year Treasury bond ETF. Basically, if you have to go back to 2008 or 2011 to get to prices that we're seeing right now, those were also higher rate periods. So if you have a long-term horizon, and honestly, the effect of rates on these ETFs on these longer terms can be drastic. So long story short, we like these long-term bonds to lock in rates and maybe get some capital appreciation when and if rates go down.
Yeah, we're going to be talking, and as we adjust portfolios next for clients, we have some updates to the fixed income, and clients will be speaking to you specifically about that one. So, and we are seeing a study that we're doing. We are seeing tips showing some relative outperformance to their counterparts in non-inflation adjusted fixed income. Okay. Kind of a fun chart here. This is shifting gears, kind of going into the markets a little bit. Seasonality. We use this one in the trading analysis report, the sector industry stock report that we do with Julius DeKimbanar over on trading analysis, the research business. Real quickly, I'll let you go back and look at this if you like. We're looking at S&P, 10-year treasuries, gold, the dollar, and crude. And what we're doing is looking at the average percent return for each month for each of these main markets. The S&P, Kyle, on average, going back to 1950, this is the second best month of the year. April and November is the best month. Here's where we are for April right now. I captured this yesterday, so we might need to throw another 1.5% lower on that one. So that's where we are for the month. So April is a strong month. April is the second weakest month for treasuries. Okay, the weakest is February. If treasuries are weak, that means their corresponding yield is strong. So that's what we don't want. That's what's hurting the market. And here's where treasuries are 10 years for the month, down 2.6, way out of whack. Gold has a decent month in April. This is the average return. Here's where we are now, just bonkers. The dollar is typically weak in April, the second weakest month of the year. Here's where the dollar is, ripping on the upside. Crude oil, this is the best month of the year seasonally. And the little diamond is hidden in here. I hate to say it, but seasonally, Kyle, and I know you don't want to hear this, but the averages put crude oil up 4.5% for April. We're only up 1.3 as of yesterday. So hopefully it doesn't go higher, because for everything we just talked about, that could be problematic. So to the stock market, very simple, none of the voodoo technicals that we do. So here's the monthly of the S&P. Here's where we've been. There's the 2022 lows, 23. Here's Q3, Q4 of 23 that we've enjoyed riding up. We broke out above these highs. what was resistance should become support. The big level was 48.19, and it looks like we're coming back potentially to retest the breakout. Moving from the monthly chart, which each one of these guys is 1 month, over to the weekly. Each one of these guys is 1 week. That 48.19 level in the S&P is going to be key. That's the line in the sand right there. Okay, so we broke above it early this year, rallied all the way up, and now we're coming back to it, which is quite common. It doesn't feel good during it, but it's very common market behavior. This market has been straight up with 1 week, 2 weeks, and I wouldn't even call that a negative week because that little blue candle. We've had 2 weeks of negative price action, Kyle, since Q4 of 23, and now it's April.
Yeah.
Think about that.
So a correction, it's like brings sanity back to the market based on how well it's been doing.
We're not used to this. Like,
yeah,
markets aren't supposed to go down. We've had 2 down weeks since the top. Now we've had 3 down weeks, but since the top we had 2 down weeks, and they weren't even anything, very small since the end of 23. So I don't mean to make light of it. Listen, I hate the drawdown. You're running money as we do. I hate it, but we have the profits. We have the unrealized profits to give because we have good cost basis. So we're staying calm. We're assessing all of the macro impacts that are driving this lower, and I think we're pretty clear as to why this is happening. We are now in earnings season. There is a lot of geopolitical uncertainty, macro forces that are driving stocks lower, and plus, we've just gone straight up. All of that other stuff aside, markets don't go straight anywhere. Okay, there's gonna be profit taking on this, and they just basically took out technology, specifically semiconductors today, and shot it. And I shouldn't say that in this horrible geopolitical, escalated tensions overseas, but they really, really took semis out. This is a sort of an algorithmic software that we use watching the rotation of the major stock market groups. So we look at large cap growth, mid cap growth, small cap growth stocks, large cap value, mid cap value, small cap value. And we watch them rotate around some central bank benchmark, which we use as the Vanguard total stock market, own every stock in the land VTI. What the takeaway is here is large cap growth is on the right side over the last 6 months, which means we've seen outperformance in large cap growth stocks. That's Google, that's Nvidia, that's, all of your large semis and technology and communications and Amazon consumer discretionary. But we are seeing the value trade start to rotate in, and this software shows you basically underperformance is on the left side to your central benchmark, outperformance is on the right side, and it does rotate in a clockwise fashion. So we are seeing the beginnings of a rotation out of growth, which again is tech, communications, and some consumer discretionary, and a move into value, which is energy, materials, industrials, even utilities, staples, real estate. So we need to watch this rotation into value, and there is a very clear correlation with interest rates. Long story, but the blue guy is a ratio. You take the value stock ETF, divide it into the growth stock ETF. As the blue line's going up, that means value stocks are outperforming growth stocks. As the blue line's going down, value stocks are underperforming growth stocks underperforming value. And as these 10-year yields were spiking from 22 in response to the inflationary forces, interest rates go up, that makes the argument to want to hold growth stocks hard to make. That's why we see value outperform growth as interest rates were rallying. Okay, well, in the beginning of this year, the value growth ratio said, all right, enough of this, and began to sell off, which means value is underperforming growth. Growth stocks have been outperforming value because the ratio is moving lower. That was counter to the traditional relationship as interest rates went up. We sold off on interest rates, as we've talked about, and now we're rallying in response to the Fed not cutting. The value growth ratio is like, okay, where do we go now? It's kind of like forming a base. See the low here, the low here, the low here. Where do we go? Does it want to move up in favor of value out of growth? Kind of what this rotation graph is telling us is we're rotating into value out of growth. Or does this guy break through the 0.40 support level and the outperformance of growth relative to value continues? And I'll tell you, it's going to have a big impact by where those interest rates go. And that is, that's the key driver of the stock market here. This is the reason. It's related to interest rates, crude oil as a result of Middle Eastern tensions, interest rates, like that's what's driving the stock market, plus profit taking, position squaring, which is kind of typical before we really get into the heart of earnings season. Seasonality for the sectors, I'll let you take a look at this one if you're so interested. Same thing. You look at traditionally what is strong for each of the sectors that make up the S&P 500. The diamond is where we are. Energy usually has the best month in April. It's crazy, Kyle. Energy as of yesterday or 2 days ago was flat on the month. You can't even see the diamond. Materials has usually a good month in April. We're down. Everything's down right now. So, I'll kind of let you, work with that chart if it's something you're interested to know where the rotation is. But most interesting, we're interested in May, which we're moving into a seasonally weak period, which is May. But I think by looking at the diamonds, looking at the negative returns for all the major sectors, we may have pulled that ahead a little bit for May. Julius gave us this. I'll let you peruse that, but this is the amount of times each sector, materials, comms, energy, financials, the percent of time that it outperforms the market, the S&P, and by how much down here. Okay, I'll let you work on that one. This one is really interesting. This is from Stock Traders Almanac, Jeff Hirsch, buddy of mine. The book is right here. Seasonally speaking, looking from 1971 to 2022, this is election years. The last, call it 49 plus 22, whatever that is, 3 years or something?
The three,
No.
yeah.
What is that? 29 and 22. My mind is spent. I can't do that right now. Whatever that is, a lot of decades.
52 years, yeah.
52. All right, thanks.
The 53, we'll call it.
I think it's 53. So I know the colors are hard to see, but this right here, this is the average NASDAQ behavior in election years. It's right now. The low on average is right now as we rally into the election, because the incumbents are going to do what they can to boost the market, especially with what's happening now. So goes back to the conversation, Kyle. What's their position? Are they going to try to de-escalate overseas, especially as we're in the election year, or is some kind of overseas conflict good for re-election probabilities because they don't want to change who's in charge? That's a deeper discussion, but this is the NASDAQ and this is the Russell 1000, which is most large cap and mid cap stocks. So we're coming into, for the rest of the year, for election years, a very strong seasonal period, which I find very interesting considering today's sell-off. Okay, so gold is breaking out. Yes, I think a lot of people are calling it a risk-off signal in reaction to inflation. I see it a different way. Looking at the NASDAQ on top of gold, I think the reason that gold is rallying is the same reason that stocks have been rallying, and that is interest rates have been mostly under control. Interest rates dropping generally puts the dollar lower, which makes gold go bid. Those same reasons, lower U.S. interest rates and the lower U.S. dollar, are good for the stock market. So the same two supporting markets, lower rates, lower dollar, are boosting gold and S&P and the NASDAQ and the S&P. So you would therefore make the the takeaway that gold and stocks, I think, are potentially correlated. That's being tested right now. Gold made the move as stocks starting to roll over. Again, I think it really goes back to where interest rates go. Moving quickly, I wrote an article for CNBC today about a holding in our portfolio, a copper stock. People are so fired up about the gold market because of the fear in the Middle East, inflation scares, and they think it's a risk-off flight to safety. If you look at the actual metals, the miners, the industrials, base metals, precious metals, which includes copper, which includes steel, gold, silver, zinc, iron ore, those groups are actually stronger than gold. So it's not gold that's outperforming. Look at copper compared to gold. It's further to the right in the relative rotation. Copper stocks are stronger than gold. That's not in line with the narrative that, we're running into gold because of fear of inflation and a risk off, fear of a slowdown in growth.
Yeah.
Copper breaking out above 435. Here's a holding of ours, Southern Copper. We've held this for a while. It's one of the best performing stocks that we have, and we have losers too, of course. But if we get continuation up here as copper's breaking out, there's a lot of reasons why copper demand foretells strong economic growth, which that's counter to the narrative that the market's slowing down, economy's slowing down, people rushing into gold for safety. Why is copper outperforming gold in copper stocks? Sort of related to that, international markets, commodities, mining, commodity-sensitive economies. We are seeing a rotation into international markets, which is something we need to consider. China is actually starting to bottom. Chinese authorities are pumping a ton of liquidity in the system to boost their economic slowdown. Emerging markets, BRICS 50, Mexico, which is an ETF we hold, we're seeing a rotation in relative to the S&P. We may need to look overseas because we're seeing rotation there. Finally, we have two little pieces, I think, of happy good news. Bitcoin is right on the breakout of all-time highs. There's something called the halving, which is basically the amount of Bitcoin that's awarded to miners when they solve the equation. Generally, it's positive for Bitcoin. We're looking to add the Bitcoin ETF into our growth portfolio, so we may be doing that on the next rebalance. And those of you who are concerned with our custodian, who is Charles Schwab, they reported earnings. They beat earnings. The headlines from the report are they now have $9 trillion under management. That number is in here somewhere.
Second line from the top.
Second
in
line.
In the headings.
Oh, thank you.
Going. Yeah, there it is.
There you go. Total clients' assets are $9.1 trillion, up 20% year over year. Pre-tax margin, they're running 38% margins, and they grew their assets by $45 billion, which is a growth of 6%. So they beat earnings. And look at the chart. Trust me, during the regional bank, concern, we were watching as Schwab is our custodian, but how things have changed. And I'll tell you what, in a very bad tape, this is a technical chart combined with an earnings report that really doesn't look bad. A little breakout there in Charles Schwab. So just sort of a little silver lining here to this crazy market.
And they were saying that some people that came over from TD were moving out, so that growth is with the people from TD that wanted to leave baked into that number, and they were still growing. So
that's interesting. I wonder how much they lost on that.
Yeah.
Oh yeah, good point. Good
point. I don't know the exact number either, but they did say it was happening still, and that so they were growth on despite that.
Yeah. Nice. All right. Sorry, sir, to steamroll that. I love to normally go back and forth, but I've got a bunch of kids who are looking for me on a baseball field, and I need it after this week.
Yeah, we can start our weekend now.
Yeah, but to clients, we're this is, obviously a public address, but to clients of Inside Edge, will be in contact, and we're very much on top of this, and we're monitoring this very closely. As I said, the support levels in the market, we're watching them. We're watching the rotation. We can ease up on the, on the on the aggressiveness of the portfolio as we can. We can put hedges in. We are very much on top of this, and just rest assured that, with the financial plan you've done with Kyle, that helps you see through the volatility pockets, which, we're clearly in one. Stay the plan. We're working hard at the model level, and if things were to escalate further, we're gonna make adjustments. But right now, it really seems like position squaring before we get into the real heart of earnings season, and we just have to watch those macro influences. So we're on top of it. Any questions, reach out to either Kyle or I, and info is right there. If not, check us out at Inside Edge Capital. And closing thoughts, sir?
Not so much. Just thanks for your time. Thanks for watching the video, and we'll be in touch more often and soon.
Well said.